Hello everyone. Today I will talk about case number 19, which is about bankruptcy and reorganization. Is it worth more dead or alive? To give a short background regarding this topic, I would like to first define the key terms that will be used throughout the case, which are bankruptcy, reorganization, and insolvency. According to Encyclopedia, bankruptcy is a legal term for when a person or business cannot repay their outstanding debts. The bankruptcy process begins with the petition filed by the debtors, which is most common, or on behalf of creditors, which is less common. All of the debtor's assets are measured and evaluated, and the assets may be used to repay a portion of outstanding debt. Bankruptcy offers an individual or business a chance to start fresh by uh, forgiving debt that simply cannot be paid, while offering creditors a chance to obtain some measure of repayment based on the individual's or business's assets available for liquidation. And in theory, the ability to file for bankruptcy can benefit an overall economy by giving persons and businesses a second chance to gain access to customer customer credit, and by providing creditors with a measure of debt prepayment. Upon the successful completion of bankruptcy proceedings, the debtor is relieved of the debt obligations incurred prior prior to filing for bankruptcy. Reorganization is a process designed to relieve a financially troubled or bankrupt firm. A reorganization involves the restatement of assets and liabilities, as well as holding talks with creditors in order to make arrangements for maintaining repayments. Reorganization is an attempt to extend the life of company facing bankruptcy through special arrangement and restructuring in order to minimizing the possibility of past situations. Minimizing the ability of past situation uh, um, reoccurring. Generally, reorganization marks the change in the company's tax structure. Reorganization can also mean a change in structure or ownership of a company through a merger or consolidation. So, a spin-off accumulation, transfer, recapitalization, or change and identify or management structure. Such an endeavor is also known as restructuring. Insolvency is a term for when an individual or organization can no longer meet its financial obligation with its lender or lenders as debt become due before insolvent company or person gets involved in insolvency proceedings. It will likely be involved in informal arrangement with creditors, such as making alternative payment arrangement. Insolvency can arise from poor cash management, re- re- reduction in cash inflow forecast, or from an increase in expenses. Insolvency is a state of financial distress in which someone is unable to pay their bills. It can lead to insolvency proceedings in which legal action will be taken against the insolvent entity. The asset may be liquidated to pay off outstanding debt. They are no, 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 they are like a big factors that can contribute a person or company's insolvency. Just to clarify the things out of starting, I would like to differentiate insolvency versus bankruptcy. Contrary to what most people believe, insolvency is not the same thing as bankruptcy. Um, Insolvency is a type of financial distress, meaning a financial state in which a person or entity is no longer able to pay the bills or other obligations. The Internal Revenue Service states assets states that a person is insolvent when a total liability exceeds the total asset. But a bankruptcy is an actual a court order that shows just how an individual person or business will pay off his creditors, or how he will sell his asset in order to make the payments. So a person or corporation can be insolvent without being bankrupt, even if it is only that temporary situation. If, if that does extend longer than anticipated, it can however lead to bankruptcy. It will begin to discuss the case proper. So, Delaware Corporation incorporated in 1985 was under severe financial distress. Alex Peterson should decide about whether should vote in favor or against the reorganization plan. That the Delaware Corporation designed, manufacturing, imported, and marketed different menswear. Though the significantly lower profit margin and declining demand caused by the increasing competition and weak economic conditions. The company faced several losses and liquidity, poor liquidity condition during the past 3 years. So, Delaware Corporation has proposed to their creditors a restructuring of their loan term by offering their senior notes to be converted into the common stock. While there are advantages to this step, there are so disadvantages. So, advantages of this would be that the company may save time and expenses by being extended of their payment to debits. The disadvantages would be that if they fail to become profitable even after reorganization plan, the former creditors would resist and become more aggressive in collecting their pay, which may further lead to the destruction of the company itself. Since Alex is creditor to the company through his partial senior notes, he is directly involved in this dilemma. In order to determine whether it would be worth it for Alex to agree with the reorganization proposal or not, financial ratio analysis was used. So ratios such as current ratio, long-term debit to equal ratio, total debit to equity ratio, debit ratio, financial leverage ratio, and property ratio. So the strength of the company would be its higher asset compared to liabilities and good current ratio, low long-term debt to equity ratio, high total debt to equity ratio, and low debt ratio. The current ratio of Durware was computed as 2.5, which is highly desirable for the company because this means that their current assets are 2.5 times more than enough to pay their short-term obligations. The long-term debt to equity ratio was computed as 0.33, which is uh, relatively lower. This means that the company is a little bit risk average as the high result for this ratio means that the company is more risky. The total debit the, tot- the total debt to equity ratio was computed as 1.38, which is which indicates that more credit financing through loans is used more than investor financing from shareholder by 1.38 times. The debt ratio of the company is 0.675, which is interpreted as the company having less liabilities than its assets. A ratio higher than one would mean that the considerable portion of the debt is